I was making thousands of dollars a day on a sub $15,000 account. I realized that if I ever wanted to get the life that I really wanted, I was gonna have to have supplemental income. As a scientist, if you can't replicate something, hurts your thesis. And they'll always say, oh, growth always beats out. And it doesn't. Probably the biggest factor pushing me towards anything dividend or distribution related is the compounding effect. Difference between us and the guys that have millions of dollars is it makes a much larger impact on us, what the market does, what our investments do. You're going to make mistakes, they're going to cost you money. But the reality is, what you've learned, you just have to charge that price to it. Just like the idea of using my money to grow more money, and anybody can do it. You don't have to be an expert in the stock market, make money in it, or to be setting yourself up for the future. And I don't have any desire to be ultra rich. I just want to be, happy, healthy, safe, and secure.
Investors, welcome back to another go-round worth of Masters of the Market. This week, I could not be more excited to have Spencer from Spencer Invest on with me to talk all things ETF related in investing. So Spencer, first and foremost, welcome to Masters of the Market. I want to go ahead and pass you the first question that, as you know, I ask every guest here who comes on the show, which is, what's your story and how exactly did you get started investing?
Oh, good question. Good question. I'm not from the finance niche with my job, but I started investing when I was 17, 18. I had my first summer job. My dad's an accountant, so numbers have always kind of been his thing and kind of my thing by association. So from then on, I just liked the idea of using my money to grow more money. And they were really strict. My parents were on money and what we could spend and what we should be doing with it. So from an early age, I started investing. I started out with ETFs on Fidelity and then slowly grew into learning more about the stock market, more about ETFs, how to make money, how to invest based off the lifestyle that you want, setting specific goals, and just kind of grew from there. But the thing is, I'm really just kind of an average guy when it comes to the investment thing. Like I said, I'm not in the finance niche with my profession, so I kind of like to look at that as anybody can do it. You don't have to be an expert in the stock market to make money in it or to be setting yourself up for the future, for retirement. And that's kind of how it all began. And then it's grown exponentially from there. I can't even believe it.
Spencer, I know because we met back in Vegas at a conference, so I know your story quite well and how you really don't come from, a background of finance. So talk to us a little bit about the background that you do come from. And then moreover, I'd love to understand, okay, your dad's an accountant, but it does take a certain individual or a certain mindset to really jump into the stock market and start to invest. So what were some of the pulls? Because you do come from quite a safer, I want to say, background, and I would say less speculative background.
Definitely. Yeah, so my background, I am a full-time biologist. So science, it's really interesting because science and finance have not a lot in common. You do things very differently. Yeah, there's not a lot of crossover with my profession versus, the things that I like to do on the side. I can't even give a specific point when it really started. I guess the idea was kind of, I was always interested in using my money wisely. And the first stuff I really learned, I learned a decent amount from my father and how he invested. My father, being an accountant, he's really risk averse. So lower yields, that's what he's happy with. He's happy to let it sit for a really long time. He's made some insane returns on low risk investments over a 35-year period. He's been investing since he was in his early 20s, which was really motivating. And initially those conversations were fun. I was kind of growing up a bit more, turning into a teenager and then a full-blown adult, and being able to have that connection with my father was a really big deal. I would call him the market did this today. What should I do? What are you doing? And he always said the exact same thing. I'll just hold it. He never really worried. So I did learn quite a bit from him, but he kind of gave me that introduction, which then picked up exponentially from YouTube. So YouTube was my education. It was, I never did courses and stuff like that, but I've been watching dividend investors, growth investors, penny stock investors, kind of every niche in the market just to learn what I liked and what I thought would kind of co-align with my lifestyle and what I'm looking for long-term wise. And so, Ari, I've been watching videos, I don't even know how long, years ago. That's the thing. It's years ago. And they were just, they're informative. And I loved it because it's free, right? That's one thing that I was always upset about with school was you never got to learn. I felt like you never really learned about the stuff you really wanted to. I remember taking a personal finance course in college. It blew my mind. We talked about the stock market. It was the first time I'd ever had anyone teach me just the basics on it in an actual classroom setting versus just learning from all this free stuff on YouTube. And so that was definitely a big point in my shift into really diving into the finance world and trying to understand it. But that's the thing with social media these days. And I think that is going to play a massive role in the decades coming forward, because you don't have to be a finance expert. You don't have to have 25 years of investing experience to get people to watch your channel or to discuss with you in the comments or anything along those lines. So that was definitely, I hope that answers the questions. But that was definitely the big point. YouTube changed a lot for me.
You've not only become the biologist, but a biologist now with a financial YouTube channel with quite a large following. Question now comes to you, like when you're pumping content out there, how did you land on specifically ETFs? Because there's so many, as you know, opportunities for you to dive into growth stocks, dividend specific stocks. And a lot of people out there would say that the ideal for guys like you and I would be actually to go head first into growth stock opportunities. Why not go into growth stocks? Or were there any YouTubers that helped shape you into more of an ETF investor? As we'll all come to find, Spencer isn't just the typical ETF investor. We're going to get into what types of ETFs he actually invests into, but I'll leave you with that question first, Spencer.
The interesting part with my YouTube journey is that it definitely has shaped me a lot more in my investment style than I anticipated it would. So initially, I've been posting content, I think, for little over 3 years now. I started in my parents' house when I was living there. I would start with just normal dividend content. I'd watch Ryan, he'd talk about dividend stocks. I would be like, yes. I'd watch Ari talk about dividend stocks. And that's where I still have investments that I bought during that initial period where they've just done well and I've held them. The ETF stuff has really been a shift for me more recently, within the last year, really. And the reasoning behind that is I would say that I'm kind of a jack of all trades. And I do own, like if you looked at my portfolio, it's random. There's certain growth stocks that I like. It's a lot of ETFs and just a lot of dividend-focused investing. These ETFs just kind of took the world by storm, At first, I've bounced stuff off my dad, because the first time we talked about like monthly income, he's always been like a quarterly dividend guy. They all paid him quarterly, and he would use that money and put it into something else, or, save up and buy a car with it or something like that. And I was like, Dad, like they have monthly ETFs. Like, did you know that? You can literally get some really solid returns and get like income. And he's always been the same type of investor. I never expected him to change. He has bought a few newer things recently that I'm proud of him for branching out a little bit. It's so interesting how these ETFs they're constantly changing. And with when we're throwing things out there too, like crypto. Crypto is something that's constantly changing, and it's kind of a newer investor's game. And I see the same thing with ETFs, because these new ETFs, like weekly paying dividend ETFs, which I'm sure we're going to talk about more, it just changes so much about how you can invest, but also how you can live. And that's what I really enjoy about these income ETFs, is you can start crossing things off that you have to pay every month using money that you have sitting in an account somewhere that's going to pay you. And so for me, like one of my first series I ever did on, I think it was one of the JP Morgan ETFs, I wrote a video like, how much do I have to buy to pay for my monthly car payment? I made the video, and one of them did pretty well. And I was like, this is actually really cool, because if I did buy this number of shares and it, maintained trading, there's always a level of risk. We're assuming a bunch, depending on what the market's going to do and the yields, if they average out the same. But you end up like, wow, I'm able to use money that I've already made, I've already worked for, to pay for something and to kind of support my lifestyle. And that's the thing, is now looking back at that time, my car is paid off. And so then I'm like, well, what am I going to do with that money now? Well, you can roll it into the next thing. You can reinvest it. You can, there's so much that you can do with this money. And it really kind of morphed from, once I finished my schooling, I realized how money, it's good and evil, I would say, because it is so important in everyday life. And I realized that if I ever wanted to get the life that like I really wanted, I was going to have supplemental income, because I don't know if you know about the field of biology. It's not high grossing. There's not a ton. It's very good, consistent work, but I'm not going to be, sitting at the $500,000 a year when I retire and stuff like that. It's good, solid, steady work. The crazy thing with it is it allows me to get consistent income and kind of fuel my hobbies, fuel investing. And it gives me a lot of, I do love what I do. I'm definitely not complaining. I like to say I'm a science nerd and a finance nerd. I don't really have one niche in that aspect. It kind of supports all of my stuff on the side. And so these income ETFs, one, I think we're in a time period where we're going to look back on this next year or two and we're going to be like, what is going on with ETFs? We're going to see an insane rapid progression because we have very quickly gone from monthly to weekly. There's rumor of daily. I get people in my comments talking about hourly, and I'm like, I don't know how that's ever going to work out. And, the expense ratios, the expense fees on those are going to be astronomical, but I do really like it. And we've kind of seen this fluctuation where investors are, I almost felt like empowered. And I kind of talked on my channel about that a little bit because we are using our retail investment. I know these are higher risk, some of the newer ones. Everything's new when it's, or high risk when it's new, I would say, just because you don't know how it's going to trade or the reaction it's going to get. But our retail investors are fueling what these large companies are doing. This is multi-million dollars that they are investing in creating funds and removing funds and shifting them from monthly to weekly payers simply because people on Twitter are reaching out and saying, make this weekly. With our money, of course, they're making a profit, off those fees, but it's really cool seeing that we have such a solid impact on where the market's going and kind of the future of ETF investing as long as they can be sustainable, I'd say.
Well, it's really interesting to me. I mean, again, because you are a younger investor and you really do have the time right now to be like fully invested into some real quality growth stocks. But yet again, I mean, you're kind of more focused on income, which I get because you're saying, it helps fuel a lot of your passion projects and, payments for other things. But as a biologist looking to get that, $500,000 at one point to $1 million plus, which undoubtedly I think you will get there eventually at the rate that you're going. So I want to ask, why not just go all growth? And what do you think when an investor approaches the market is the best approach? And we'll go with, an investor who's younger like us, and we'll go with an investor who's older, perhaps your father's age or beyond that.
I feel like it is shifting. It's definitely, it changes, right? Like I go back and forth, the market we're in right now, it's a little bit rocky. So I've been going a little bit safer. I have some growth ETFs. I'm kind of, testing the waters on those. But for me, when it came down to it, dividends, that's what I would say. Whether it be ETFs, whether it be stocks, I tracked the different returns from some really popular dividend stocks, some dividend ETFs, and put those returns up against a lot of the growth ETFs that really perform really well. And now I will say, I'm not bashing anyone based off if they want growth. I think the style of investment that everybody should do is whatever keeps them consistently interested in investing. Even if it's penny stocks, and that I might regret saying that, but if you like penny stocks and it keeps you in the market, put some money in penny stocks when you feel like it, And that's the thing is it is your future. You're planning for your future, but you're going to grow. You're going to develop and you're going to adapt to what's going on around you. But when it comes to the older versus younger, I definitely don't think there's anything wrong with growth ETFs. For me, I get some really serious validation when I get a dividend payment. And for a lot of my consistent dividend growers, I have one right now and I'll say this, I bought it off of pure luck. I am not one of the YouTube gurus that thinks they can do no wrong, that hides my flaws and whatnot. I bought this very early on, post-pandemic, when everything absolutely was super low, and it's like my highest return right now, percentage-wise. At one point, I was up over 160%, and it's just it's like a 6% yielding stock, and it just grew and grew and grew. The dividends consistently bought more and more and more, and they raised my cost basis. And I was every month checking in and being like, wow, I bought more at this. I bought more at this. And it really shifted like, wow, over time, you use time in the market and you reinvest your dividends. If you're able to not live off of them too, that can be an entire sort of supplemental income. And so my goal now is to surpass my income with dividends every single year. And it's a long-term goal. I'm not going to be doing that probably even, I would say, a decade. Maybe in a decade, I'll be getting somewhere close, but it's going to take a lot of time. And on top of that, things shift. So I purchased a home about 2 years ago, and that was a big decision that I didn't realize was going to, take away from my ability to invest. Putting $30,000 as a down payment, that's money that I could have invested. And so you really have to figure out what you want to do and what's going to be the best for your lifestyle, because $30,000 at a 10% rate is some pretty decent money that you can grow over time. But all in all, I decided I want a home. I want a little bit of diversification as well, because real estate, stocks, I don't want to be fully into one. But that's kind of it. I really recommend everyone figure out what you like to do. And that's a big portion of my channel, right? Is not figuring out what I want to do, but I buy ETFs that people are like, I'm curious how they're going to work out. And so I buy them and I show you what they do. And the goal is for people to, one, find it entertaining, and it is entertaining. I'll be whining on there. These last couple weeks have been rough. Things have been dropping like crazy. So it's also kind of like a news channel in a way, ever so slightly, but just on those specific ones. But then also, covering stuff like long-term retirement buys that I love, lower yielding, more consistent returns that can outmatch some of these growth ETFs. And one thing I will say, probably the biggest factor pushing me towards anything dividend or distribution related is the compounding effect. Being able to use that money to instantly buy more shares, to instantly buy when you're down. And I've been talking about that with my weekly dividend ETF update videos, where on the chart, when I have drip on, you can see, like, I'll zoom out on the chart and it shows every buy position, and then it's like tanking, right? But I'm buying more and more on these low prices. So when it does even go up a little bit, all of a sudden my returns are very solid because I've been buying fractions way down here. As it goes back up, it ends up working out a lot better for me. The only factor is you have to have something that's going to go back up, which, depending on this market we're in, it takes a bit of time and you kind of have to stomach those losses. But that's the thing. ETFs kind of opened my eyes to how you can really utilize the stock market in almost everyday life. I remember when I got to the point with one of my accounts where I was like, I could buy a burger from McDonald's every day of the year with the dividends I'm making. Now, if I did that, it'd be a horrible decision. I would be, heavily, I'm really heavy at the end of the year. But I realized, like, that's how you can actually utilize stock investing now, because I do think our generation, being younger, we like that instant gratification. It is hard. Like, I'll look at some comments on my channel if I'm talking about something more conservative. They're like, you want to make 12% a year for 30 years? That takes forever. Put it into this ETF or into this investment, and you can make 200% in a year or two. And yeah, like, maybe you can, but the chances of that ETF performing at that rate consistently are low, because if it was that easy, if it was possible for every ETF to outperform the market over and over and over again, well, they'd be doing it and they'd be making a fortune on fees to do it. So you kind of have to understand that side of things, which is, again, goes into the growth aspect of, once you've been investing for longer, once you've seen these different market swings, it makes a really big difference. Because I've been watching the stock market since I was 16. So it's been a long time watching. I started with $1,000 and, kind of work your way up, but it's definitely been a journey.
Spencer, I want to dig in. You said a whole lot, so I got a lot of questions now for you. And the first question I want to tackle is something that you initially started to share, which was, every investor really has to kind of figure themselves out and where they are and what they want to invest into. Now, you went in the direction of purchasing real estate for yourself and, also doubling down on these dividend-paying ETFs, real income-producing ETFs, and I'm sure, other passion projects along the way. How did you figure out that those investment puzzle pieces were for your puzzle?
It wasn't an instant thing. It definitely took a lot of time and a lot of research to figure out, one, how can I do it? How can I wrap my head around an investment strategy that's going to fit all the boxes that I have for what I'm looking for? Consistent returns, relatively good upside, kind of getting this ultra specific niche that's just to how I invest. And it definitely isn't easy, and it is constantly changing, but learning and researching as much as possible. And that, again, kind of leads to where my YouTube channel has gone. It was hard for me to find a channel. Like, you always find content on, oh, here's this ETF, here's what it's yielding, and here's what it does, right? And then that's the video. There's not often a follow-up. There's not a long, history of what it's doing. And I always like looking at the histories and seeing how they have performed, even if it's not necessarily indicative of what it will do. And that really shifted my content, because now, like, my weekly account, I think I'm on update 27. So I've made 27 videos. I've invested for 27 weeks. And that was kind of my goal, not only for the channel, but also for my own investment style, was to look back and see what has made me money, what has been consistently a good returner for me, and what am I happy with. And you learn, like, this is making me think back to all the mistakes I made and everything, which is great. You learn more from your mistakes, but you learn so much along the way. you learn that sometimes, you have to sell when something's in the red if it's just going to keep going down. And like I said, I'm not overhyping my investment strategy. I've made so many mistakes and bought stocks that have just tanked. I've played the penny stock game, and that's how I know the penny stock game is not for me, because it just never worked for me. And some people can do it. That's the thing. That's another big factor, I would say, with filling the boxes and figuring out how you want to invest, is do not compare yourself to someone else. They have a different history. They have a different, they've made different mistakes than you. Maybe they make more money in the penny stock niche, or they're more vocal about it. But I definitely struggle with that side of YouTube. It was one of the biggest things that kept me from being on YouTube ever, is because I don't want people to think that I'm like not genuine about this stuff, because there's I'm sure you get it a lot too, Ari, with your channel, where it's like, oh, all you want is people to watch your videos so you can get some pennies in ad revenue, and there you go. When it's like, no, this is like, one, it's life-changing for us. We get to build communities of people that are going to give us, their opinions on stuff. And that's something that came out of the channel that I never anticipated. I would never say that I'm the smartest guy in the room, and I'm not the smartest guy on my channel. There are people in the comments that have been investing for 30 years, and they'll give me their input, and it is like good as gold. Like, I would pay someone to tell me some of this stuff. And I'm always like, start a YouTube channel. You could do really well, like trying to get them to do something with it too, because, our ability as retail investors, the difference between us and the guys that have millions of dollars is it makes a much larger impact on us, what the market does, what our investments do, because we're depending on this stuff. This is potentially going to be like, for me, it's my retirement. I do have a retirement through my job, but this is my retirement, like, for if I really want to live the life that I want to. And I don't have any desire to be ultra rich. I just want to be, happy, healthy, safe, and secure. And that's really shifted how I've been investing. And that's what I would say. I would say you have to follow, and you have to kind of learn and research what you want to do. Nothing's going to come easily, unfortunately. If it was easy, everybody would be doing it. Nothing's going to come easy, but you really learn about yourself, learn what you like, and then be open to adapting. Whether it be if you change, if the market changes, we're going to get older. I imagine when I turn, 60, I will probably move most of my investments into some low-yielding T-bills that I can, sleep at night. Or if I start investing with significantly more money than I have now, these losses are going to hurt a bit more. And so take the time now. If you are younger, take the time now to learn. Don't go absolutely insane. Diversify. You can always I always recommend like maybe 80% in solidified, secure style of investments that have good returns, and then you can play with the 20%. And if that's what keeps you keeping that 80% funded, then do it. If it's going to cost you some money for fun to play penny stocks or these crazy new ETFs that are yielding 200%, do it. Because long term, that money that you're putting in the secure investments, that's what's really going to grow. And that's really how I started. And what I ended up doing was I just ended up stop using like the fun money. And I was like, well, I'm not making money with it. I would usually break kind of close to even. I tried swing trading. I did like the biopharmaceutical plays where I made some insane returns. But the thing is, it's not like I couldn't do it over and over and over again. And as a scientist, if you can't replicate something, it's not like, I don't even know the terminology that I would use with it, but if you can't replicate something, it hurts your thesis, right? Because you can't do it over and over and over again. It happened one-off. Could just be a random luck thing. And so that's really what's kind of shifted the way that I invest. If you're an older investor and you're interested, in playing with some of the new stuff, I definitely would recommend it. It can be cool, but again, keep in mind what you're doing, what your goals are all the way through.
So many knowledge bites in there, I feel like, for investors of all types and of all ages. So it really is, insightful to hear you. Spencer, one of the things that really caught my attention when we were in Vegas together was when you were talking about the ETFs that you're invested into. And this is really where I want to get into the nitty-grittiness of your portfolio and have you break it all down for us. But you are big on like these leveraged ETF, these income-producing ETFs. And, as you've already alluded to, you're using this income as you go for various passion projects and other payments. For somebody out there who perhaps doesn't really understand the name of the game when it comes to income producing ETFs and why perhaps it's way easier to just go with an ETF versus an individual stock, Walk us through that process and then break down your portfolio for us from the individual stocks and just generally speaking, what you have in terms of the ETF firepower.
Great question. Yeah, these ETFs, I mean, I remember when I first researched ETFs, they seemed, slow growth. Like I said, my initial investments were all ETFs on Fidelity because that's what the guy and the professor in my college course had talked about. Like, oh, research these, find out. And they were like boasting like a 3.5% yield, dividend yield, and they would grow like probably 5% a year, somewhere around there. They were safe. And then when I started diving deeper into these ETFs, I was like, wow, the return potential is there. So one huge thing, I also studied history in school. And so, like I said, I'm just a nerd through and through. That's who I am. But the history of these funds and the shift of the stock market is something that I think will be studied drastically. One thing, like our tech, you can now buy stocks from your phone. Things are changing at such a rapid pace. I remember talking to some investors and they're like, yeah, I used to have to go to the bank and like put in an order, or I have to go to my broker, call my broker, tell them how many shares. And now I can do it. Like I could buy a stock in under a minute, logging in on my phone, doing a purchase. And so things like that are going to constantly, we've seen them happen. We have to assume that they're probably going to continue to happen. And so in the ETF space, that's what I've also seen, where this is a lot more, I wouldn't say regulated. I don't even know how I would describe it. When you look at one stock, they're limited on what they can do. But ETFs, you can build them out to do almost whatever you want to. You can find an ETF that's going to average the returns that you want, that'll have the growth aspect that you want. You can buy, I was looking at a new REIT ETF the other day. And so I do like real estate. And I was like, wow, like this is literally a giant accumulation of all high yielding REITs. And they've clumped it into one ETF and the yield is phenomenal. And so the thing with real estate that I don't talk about real estate on my channel really at all, which is kind of funny, but it appreciates in value. So, similarly to the stock market. So you're getting dividends as well as the appreciation of the assets. And that kind of blew my mind, where I was like, wow, I can literally pick and choose all these ETFs that I want and find the one that fits what I want. And that was kind of mind-blowing for me too. And I recently did a bunch of research I was using some screeners to find some different higher yielding ETFs and just checking out what's out there that I don't know about, just sitting on my bed on my laptop. And I ran this screener for like an ETF that was yielding like sub or over 8%. And there were like 1,800 results. And I was thinking like, wow, how many of these are ETFs that I would love to own that I don't even know exist yet? And that was kind of the thing that I was like, well, I need to do research, one, figure out if there are ones that I'm missing, find out if there are some that are under the radar that people might want to know about for content, as well as for my own personal investments. That's the thing. I just think ETFs are kind of the thing of the future. You can mix and match, you can build your own. There's, fractional shares. Just the way that we're going with investing is absolutely insane. And I'm really hopeful for it. And then to answer the second question, my own portfolio, it's a jumble. So I do not swing trade any stocks besides Tesla. Tesla is the only stock that I swing trade, and I like it, and it is probably one of the most profitable stocks, but that's one of the only real common stocks that I hold. Everything else, an accumulation of dividend paying stocks from all different sectors, right? So I have a lot of BDCs, business development companies. I have a lot of REITs, real estate investment trusts, all which, have kind of a focus on growth and on dividends. There was actually one that I thought was really funny. It's a REIT that owns a bunch of properties in Vegas. And so when we were in Vegas, I was looking oh, here's the properties that they own. Here's where they are. And it really is so funny because I'm an investor myself, right? I have a very small number of shares. But it's cool to be able to go there and be yep, I own a very, very, very small portion of this property, or, kind of just to pretend. Obviously, I don't actually, but through that investment. So it's cool. You start putting these things into real life terms and you start seeing the buildings and you're like, wow, technically these buildings are making me income. And that's the weirdest thought, right? Sure, it might be 1/1000th of a cent, a year, but that's still the portion that you're getting of these real assets. My portfolio has shifted. It's constantly shifting. Like I said, I do follow my own, I am constantly changing what I'm doing. I like with this big dip, I bought a lot, and I'm not financial advice, and I'm sure it's the same from Ari. I've just been buying everything because this is the first market dip that I am very secure in how I trade. So last market dip that I really experienced was the pandemic. I had days during the pandemic where my returns, I was making thousands of dollars a day on a sub $15,000 account. And so I had some extra money that I had gotten when I had finished school, and I was still in school, but I was working now because we were at home teaching or learning, and it was a huge deal because all of a sudden I'm able to trade during the day. Things have shifted, but I was watching my portfolio, and I will say my portfolio went from, I think I had invested about 9,000, and at the peak of that, I don't know if you want to call it post-pandemic era, or it was kind of during the pandemic, really, I went from $9,000 to $22,000. It absolutely blew my mind. And in my head, young, new to the market, new to this kind of trading, I was like, it's going to keep going. It did not keep going. We had one of the steepest pullbacks we've ever seen. It went back down to barely being positive, and I was devastated, right? And so the thing is, and that just goes to show you, everybody makes these mistakes. Everyone can look back on a time and be like, you know what, I was dumb. And I wouldn't even say that I shouldn't say I was dumb. I was just inexperienced. I didn't know what I was doing, and I got lucky. And that's the thing. When you look at people that have say, oh, I've been gifted at investing since the beginning, I've never made mistakes, it's just not viable because you learn so much from these mistakes. And so now looking back, this crash, I don't even know if you want to call it a crash, this pullback in the market has been a reminder of that day. And I remember, like, I was so pumped. I was like, wow, I have $22,000. Like, I'm rich, right? Like, no one has that amount of money when they're in college. And then I remember in one day, it was actually a 2-day sequence, I lost over $7,000 of my returns. And immediately I'm like, well, I'm not going to sell. It's going to go back up because I was new. It was something that I wasn't, used to experiencing before. And since then, that has been my biggest lesson. And let me tell you, Ari, I'm glad that I learned that lesson with $10,000 and not $100,000 because that would have hurt a lot more. But I think it's Dave Ramsey who always says, you're going to make mistakes. They're going to cost you money. But the reality is what you've learned, you just have to charge that price to it. So that cost me, if you want to pull it, I lost $10,000. Well, no. I spent $10,000 to learn a lesson that I will never want to learn again. And so that's kind of how I like to look at it. It makes me feel a little bit better thinking about that money and what I do with it now. It's never going to be helpful to do that. It's just the way of learning the game and understanding this stuff.
Well, look, the reality is, I was on a podcast the other day talking about exactly this. And, when you lose, quote unquote, lose money in the stock market, is it really a loss, or is it like what you're saying? It could be a lesson if you're wise enough to understand the lesson. And so to your point, that's all we're really doing is paying tuition bills when we lose. And at the end of the day, if you do lose it all, or no matter how much you lose, what's your next move, right? It's just going to be keep going, keep investing. And that's really the investor mindset. Spencer, how's your portfolio structured though? And when it comes to individual stock names, like what are some of the individual stocks that you have in there? And then break down like how many ETFs that you have, how many of them are leveraged, how many of them are like higher yielding ETFs? Do you have any S&P ETFs in there, or are those too boring for you?
I do have some, and I'm kind of funny too, Ari, because I'm leading into some of the higher ETF stuff. I made a second channel that focuses more on growth, and it's been really cool because it's exposed me to a different niche of people, and they all have different opinions on the best one. But I'll pull it up on my phone, and we can kind of walk through some of them because I invest in a Roth account. So that's my biggest thing. I try to max it out every single year. Our day to max it out was 2 days ago, and it was a struggle this year with home renovations and whatnot. But my Roth is going to be my retirement. Like I said, I do have a pension, but I don't like to just rely on one thing for retirement, and the Roth is kind of a different vessel. So first off, like I said, I have a lot of REITs. Like ABR is a REIT that I have. I own a lot of Realty Income, which is one of the kings. And that Realty Income, I understand it now. It is larger, right? You're not going to have the same growth that you've had over the last 30 years because this thing has boomed already. I think it will still be a consistent payer. And so it's interesting, the different mindsets where dividend investors versus like growth and growth ETF investors, we all have like our go-tos. And I feel like for dividends, it's realty income. Everybody knows like you're going to get a lower, maybe slightly lower return if you can buy in at some good prices. But that's like our go-to for, I'll never be like, oh, I have too much, or, oh, I should sell out of that because who knows what it's going to do. They're going to drop crazy news. That's like the dividend king for, that specific group of investors. So that's a big one for me. I think my three biggest holdings currently are Main Street Capital Corporation, another BDC that is absolutely, it is probably my favorite stock. I won't even lie. It has just performed so well. The special dividends have been amazing because of the increase in rates, yada, 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 all the little details. Tesla comes and goes. That's one that I do hold. And then now these last couple of weeks have been, again, a big shift for me. So I'm kind of going both ways. So I'm leaning more into the leveraged ETFs now. And I'm leaning more into just steady growth ETFs at the same point, maybe to counteract some of the risk that comes with each. And a lot of that has also come with that smaller channel that I'm learning what people are buying, what they like. But one thing I've always done is I compare the differences between, like, I'll take Realty Income and their last 25 years with dividends compounding, with dividend reinvestment on, and I'll compare it to the S&P 500. And I'm on all areas of YouTube. So I watch guys that are growth YouTubers for sure. And they'll always say, oh, growth always beats out. And it doesn't. And I will say it does depend on the things that you choose, the stocks you pick, of course, but also, how the yields end up going. But I remember one guy talking about how I think it was just SPY. I think it was the S&P 500 ETF, and how it had outperformed all these dividend stocks. And so I was like, let me check it myself. So I put it into a drip calculator that I use on my channel all the time. It's a phenomenal tool because it shows you the power of compounding dividends. And I put it in and I compared them, and Realty outperformed it. And it wasn't an insane return. It was like, I think they had outperformed it within it was like 20 or 30 years, but they were like, I don't know, like 1.3% better. So, you had 30% more, roughly, if my math is correct. And I was like, well, so that's not true. So I immediately was like, well, no, it re-solidified my love of dividends and using them to grow and compound. And these ETFs that are different, it's crazy because the leverage. So we'll move back into the leverage side. I realized very recently the stock market, I've known it for a while, but the stock market typically goes up. So if you truly believe that, if you believe that it only goes up, or in the long run it will go up, it makes perfect sense to use leverage. And I am risk averse for the most part. I'm not risk averse on my YouTube channel, right? That's my fun money where we go and we watch what happens and we laugh when my portfolio's down 20%. But I'm thinking like there's some new weekly paying dividend ETFs that are specific to, they are leveraged. And so they return 1.2x what the stock has done that week. And so one of them's on Tesla. And I swing trade Tesla because it is really rocky. So Tesla's not even necessarily my favorite, where it's like, well, if you look at the history and you've seen it go up, you can now convert a growth stock into a dividend paying stock. And then you get the ability to compound those dividends as well. And that's where I think maybe growth investors haven't really thought about it as much. And that's coming from a partial growth investor myself, because I love to be diversified. But you're able to use the power of compounding as well as get some growth from a fund that you really like. And so you're not capping yourself, because we know some of the like covered call ETFs, option ETFs, you are capped. And so if you're holding a fund and you think it's going to go 50%, well, then you don't want to be in like a covered call ETF, right? Because you're capped on that. Whereas it'd be better to just hold the underlying stock. And so that's what's been a big shift for me, is I'm like, well, leverage makes a lot of sense. You can make decent money with it. But again, I'm very risk averse. And so I recommend, and everyone, you have to unlock certain tiers on my brokerage to even buy the leveraged ones. I bought some the other day, and I had to go through this entire form and fill everything out and understand the risks and everything like that. So I would always recommend being super cautious and doing all your research on it. But that is definitely where I'm kind of shifting some of my money to, just to see how it does and see the overall return. Because if you like, for me, I bought a share of the S&P 500 two years ago or so, and it's done really well for me. And at that point, I was like, oh, it's at the high, but I'll keep buying it. And it just kept going higher. Well, if I think it's really, truly going to keep going higher, leverage just makes more sense. And there's so many leverage funds. I had no idea. There's 2x leverage, somewhere like 3x, where that really, When the market dips, you got to be out of those right away, which also plays into your investment strategy. And I'm not sure how you are, Ari, but I don't like trading every day. I don't even like trading every week. Like, I buy it and I really forget it. And so if you're going to be into these leveraged things, you really got to start paying attention to the market. And with my career, I can't always do that. I do a lot of field work. So I have 12-hour days in the field. I'm away from my phone. I'm out of service. So I can't always be, checking and whatnot. And that makes me nervous, But I mean, maybe I'll keep shifting some money into those, but really it comes with being more fluid with my account and exactly just doing what I feel like doing in the moment and learning from it regardless.
Spencer, you talked a little bit about just moments ago being capped with some of these ETFs. What exactly, for those of us who may be new to ETF investing and leveraged investing, what does that mean?
Great question. So these types of options ETFs, and there's a whole bunch of different styles. You can have, covered calls, you can have cash secured puts. But what it means by being capped, and they say this on all the websites as well, with the options that they're writing, there is a point where the stock, if it goes past a certain price point, so if you're writing a covered call and the stock continues to go up, if it goes past the price where you said you'd buy it, you're capped at that stopping point. Because even though you're buying it for now, technically you're buying it for cheaper than it currently is, you are getting the options premium, which is where a lot of the income side comes from it, from just options traders as well. They get their premium when you do a contract. And so if you're holding, we'll use Tesla again, if you're writing covered calls on Tesla and you write a call, I don't even know what Tesla's trading for. You write a call for $300 and it goes to 320. Well, that 300 to 320 range, you're not going to get the returns from that because you've already said, I'll sell you my shares at 300. And so these options ETFs, they're the same way, where if you have a fund, and I've said this on the channel like quite a bit of times because I don't think people do understand it, but I think it can be overlooked very easily. So if you have a stock that you think is going to grow and at an insane pace, we can look at a couple like MicroStrategy has been absolutely going nuts. Well, the returns with these covered call ETFs versus just holding the underlying stock performs better. And that's the thing, is these are not ETFs that are going to outperform the underlying stock at those paces. The goal behind these ETFs is income. It's accrued income. And so they're taking a portion of the returns of the underlying stock and they're paying them out to you in the form of income immediately, rather than having to sell a portion of your shares or to hold it and just see what happens. And so that's why they're really popular, is because, again, it just kicks that money back to you. But the underlying fund, when they do well, almost always outperforms. I don't think I've ever seen, maybe there's been some instances with like Coinbase or a couple stocks where the covered call fund will outperform based off of a kind of a slower growth pace, or if it's really volatile. But those income focused funds, they do what they're supposed to do. They're going to get you income. You're not going to get the same returns. And that's why I like to have both. So I'll buy some of the underlying stock, I'll buy some of the ETF, and then you can also, people are geniuses in the comments. They'll be like, what I do is I'll fund a portion of the underlying stock with the ETF. So I take all the dividends that are paid out or distributions from the covered call ETF, and I build a strategy in the underlying fund, or a position in the underlying fund, and then that grows. And then you can move the money around, you can reinvest it. So that's the really cool thing with those covered call funds, but you are capped from the growth end. And that's the price that you pay to get current income versus just long-term growth.
Here's a question then for you. And obviously you have your funds, from what it sounds like, within your Roth IRA. For anybody who's, again, new to investing out there, an IRA is really going to be your tax advantaged account where you can kind of shelter your cash. Can't avoid Uncle Sam forever, but you can at least shelter it. Now, with the Roth IRA that you have these funds within, it makes sense. You can invest into these leverage funds, and you're going to, based on what you're investing into and based on what you're making and the income, you're going to avoid the taxes there. But then we have a lot of investors who don't really utilize their IRAs, and they are just investing into these funds with everything that they have. Should we be concerned about, I don't know, short-term capital gains, when we're talking about investing in these leveraged funds? And what would be like a word of caution you could share with us that this approach is ideal for them, even if they don't need the income per se right now? Because again, you're getting taxed, and that's always been a concern of mine.
Definitely. And taxes are They're tough. It's a different language. My dad, he's an accountant, but he hates taxes. He always has. He's not that style of accountant. And I always said, I was like, Dad, you could make so much money doing people's taxes. And he said, it is my least favorite time of the year. He hates it. My mom has her own business, so my dad does the taxes for it. And he doesn't like it. But the taxes with this stuff, it's really complicated. And so right off the bat, I would say if you are investing, and you're not sure about it, do research, talk to a certified professional accountant, someone that can help you kind of bridge the gap, learn what you can from YouTube. That's, how I learned specifically. But the Roth IRA is interesting because that vessel, you pay taxes on the initial investment. And then when you retire at 59 and a half, no taxes. So you're able to grow. But there's also a traditional IRA, which could be great for, I usually see it as the Roth is better for younger people, traditional better for those that are a little bit older in their investing journey, but it really depends case by case. But when we're looking at these style of ETFs, the really brilliant managers understand this stuff. And I'm recently, because I invest in a Roth, I don't do the tax side of things for a lot of these short-term gains and whatnot. So I've had to kind of research it on my own. And there's return of capital, which a lot of these ETFs are able to use. And it's like a tax hack where you only pay out a certain amount. I'm going to do a full video breakdown on it, but I really want to get, cross my T's and dot my I's before I start talking about it too much because it's a really important area. But it basically saves you money on taxes is the very short version. And they do so by paying you back your initial investment or a portion of it. So you're not taxed on it quite yet. But some of these funds, and you should, not you specifically, but everyone should look into it, where if you're investing in a normal brokerage account, there are some crazy benefits to some of these funds. And they all are very, they understand taxes, the people who write the calls and how they do it. And so you have, I think it's a 60-40 return of capital versus just like short-term gains tax. And you might think, oh, that's not a big deal. It's like a 15%. I mean, that adds up over time. It can be absolutely insane. And so these fund managers, maybe they charge a little bit more in that end, but you have to take all of these things into account when you're thinking about what you're going to buy. And that is one thing I will say if you're a newer ETF investor, couple things you always have to look at the taxes, see if there are any tax benefits, because these are all going to weigh in. Look at the expense ratios, because those are all going to weigh in. If you're thinking, if you're deciding between two of these funds and they perform very similarly, the expense ratio and the taxes could be a significant difference in your long-term growth based off of how much you're going to be paying them for these things. But, and then again, what's really smart for what I plan on doing, because I plan on maxing out my Roth this year and potentially investing even more than that, is moving some of my higher or my lesser taxed ETFs into a normal brokerage account, and then putting, like my crazy Tesla or some of the weekly payers that I have, putting those directly into my Roth, because they don't have the tax benefits, and I will be destroyed on the taxes that I make compared to, keeping the ones that are more tax friendly outside. So I can actually overall make more money and avoid paying as much in taxes, because I cannot stand taxes. Least favorite thing, cannot stand them.
Uncle Sam would disagree with you, saying that the best possible thing.
Yeah.
Let's zoom out a little bit and talk on a little more broader of a spectrum. For investors across the board, I'm curious to get your take on what you have found the most common mistake that's being made amongst investors is, and why do you think it keeps happening?
Ooh, great question. Most common thing that I could say is not diversifying. And the reason it comes up all the time, and I get this on my accounts because, some of these ETFs, I'll tell you, Ari, one ETF in particular on strategy, on MicroStrategy, and it, at one point at the peak, it literally had I think a 360% return in a little over a year. And so what people run into, and I'll be honest, it is particularly newer investors that don't know that this is not a feasible long-term thing. And again, I say it's not. It could be. You never really know. So when it was up 150%, I said, oh, it's not going to keep going. It's nearly impossible. You never know what these funds are going to do. It's the magic of the market. But they will put all of their money into it. And times have been tough recently. Some of these are down 30%, 40% just in their overall profit loss on the actual purchase. That's not including, dividends, but they get super excited about it. And so they put all this money in and they go, I'm going to be rich. I'm going to be rich in 10 years. We're going to watch what happens. And I mean, the thing, it just doesn't perform how they expected. Sometimes it goes lower. Sometimes, it's just not as good of a return as they wanted. And they're like, well, this is dumb. Obviously, no one can do this. It's not worth it. And they don't continue investing. And so I always try to recommend diversification. It's probably one of the most used words in my comments from me, because and we get comments all the time like, oh, should I buy this? Should I buy that? And I always respond with, just make sure you're investing for your own, lifestyle, how you want to, and you're diversified. And diversification comes in a lot of factors, ETFs versus, REITs are very diversified from BDCs. They may both be impacted by the overall market and also impacted by interest rates, but they're separate. And then you have, the growth aspect. You have all these there's so many different investment styles that we can have, which is such a blessing. And long-term wise, I think it's really important, but people underestimate diversification. And I will say it, I'm over diversified. I think position wise, I think I have not including the YouTube accounts, because those aren't I wouldn't necessarily buy all those on my own. I think I have 30 or 40 positions in my account right now, and that's an all-time high for me. If you include YouTube, it jumps into the 70s, maybe even 80s, which is crazy to think about. But I just like to be diversified, and sometimes I'll buy a small tester position of something, see how it performs, and if I like it, keep doing more. And yeah, I think that would definitely be the most common mistake that people make. Another really funny one, I was speaking with a friend the other day, understanding, we talked about Roths a little bit. A Roth is not itself an investment. You still have to invest the money in there, because I've had friends that are like, oh yeah, I maxed out my Roth the last 3 years. I'm like, well, what's your balance at? And they're like, oh, it's my investment. And I'm like, no, but what are you making? And they're like, oh, I thought the money comes later. I'm like, no, you have to put the money into the Roth account and then buy stuff. You can't just hold it in the Roth, because it's hard to believe there's an account that gets you less returns than a bank account. But in a Roth with no percentage on uninvested cash, yeah, you're just sitting there. It's an extra bank account pretty much. So, but I would say those two are some of the really common mistakes. One is just for newer investors, and one is for maybe more novice investors that I guess technically aren't even investors yet. They just have the accounts.
Spencer, you mentioned a few times as you were just speaking that macroeconomics, can play a role in how someone's investing and when they're investing, and the implications of macroeconomics. Now, as a biologist, I'm sure, you're a big researcher and interested in what's going on. That's definitely not for everybody. I'm on the same boat as you are, at least to understand what's going on, at least at that macro perspective. Not to time the market. I always like to say that. This is not by any means to time the market, but it is a useful understanding to get to know where to invest, what sectors to look at. So we have a lot going on as we speak. I mean, Trump's been playing his, chess pieces and moving them along, and China's been doing the same. And less than 90 days, we'll probably be back at this table playing, another solid game of chess with with China and Trump. And then we have interest rates, we have inflation, we have a lot going on still. And I feel like, for the last few years now that Masters of the Market has been going on, we've heard the term unprecedented a lot, but I feel like, again, here we are again with that, term, an unprecedented year, things that are happening right now we've never seen before. How much macroeconomic news should investors be taking in? Does it matter at all for investors to understand macroeconomics? If they're invested in leverage funds, if they're invested in dividend stocks, if they're invested in growth stocks.
I think it's always nice just to have the knowledge behind it. These things are going to directly affect your account, depending on how you invest. One huge thing that I never thought about until I purchased my house was interest rates. I didn't understand how they worked. I literally had no idea. I just had never had the option to really look into it and think about it. And it had never come up. I'd always said, oh, interest rates are this, interest rates are that, depending on the REITs and BDCs and whatnot. And I was like, well, it doesn't really impact me all that much. It does. Everything's going to impact us. News is going to, tariffs are going to, all of this stuff is going to impact us. But what I keep coming back to is, why am I investing? I am investing for long-term returns, long-term goals. And if you are investing just strictly for long-term, it's a lot easier to stomach this stuff. And again, markets typically go up. So even if we're in a lull, if we're in a downtrend, things will reverse. And the funniest thing is we get into these mindsets, Ari, where we're like, wow, look at this money I've lost. And that's how I used to trade in these down markets, like my terrible trades when I did, post pandemic. And now I'm looking at it, I'm like, wow, look at how much opportunity I have. Like I had a stock, like hypothetically, like you have one that runs 20%, like an ETF over a year, and then we see this pullback and now it's back to zero. Well, now I have the opportunity to make 20% on more money that I can invest at the same point, the same stock. I'm used to it. I know, yes, I could have sold it at the top. If we had a crystal ball, we knew it was going to happen. Yes, you can make crazy money, but that's just not how it works. And that's also something I run into with a lot of different, I don't know if you call them like finfluencers, where they say like, oh, I just buy it at lows and sell it at highs and I make a bunch of money. Like, buy my course. I'll teach you how I do it. And it's like, that's not something that you can do over and over and over and over again. And I feel really bad. I've seen a lot of these courses charging thousands of dollars. And I'm literally like, if you just took that money, you invested into an education on YouTube, you learned what you could. Some people courses work better for, and that's fine. There's nothing against that. It's these ones that I don't imagine they provide a lot of value and they cost an insane amount of money, where it's like, you probably would be better just like, if you're not really interested in investing, put that money you would have spent on the course into a long-term growth ETF, into an average yield dividend stock, and see the returns that you get versus, usually day trading. I have issues with day trading. I don't like the whole, kind of niche of people that say you can get rich doing it. I've seen people get hurt in my actual life trying to do it. And I think the younger generation is really going to push into it a little bit more because they see these guys now on Instagram and on TikTok. I made 6K today day trading this way, and now I'm going to go spend my day at the beach. And that's just not something that I think you can reciprocate over and over and over again. There probably is a small percentage of people that can do it, that have an insane amount of money, which most, average Americans don't, average people don't. So that's definitely something that plays with me a lot. And that's kind of how I shape my channel to just, I want it to be a value. I want it to be entertaining, but to overall provide value to people for their investment journeys, as well. But when it comes back to the new stuff, you kind of have to take it on the chin. You can always, I hold the cash position now. I never used to do that. Now I do. When we see these dips, I buy more of my favorites, and that's just kind of something that you learn as you go. So,
it's interesting that you say that when it comes to a lot of the finfluencers who are out there, and obviously the both of us being in that realm, or line of work, whether it's part-time, full-time for some of us, the reality is I wish we all had fiduciary responsibility, because if we did, I think we'd see a lot of channels disappear very quickly, because they're in it for the money and chasing the money. And so, okay, if I set up the YouTube channel and sell you $1,000 course, at the end of the day, they don't need to make a lot of videos. But then what happens is it's like the dopamine hits, and then they see the money that they're making from the courses, so they're going to produce more videos to get to more courses. Mm-hmm. And it really is this crazy experience for them that, greed can get the best of people. And I liked what you had to share. If you just took that money and you would actually invested it into a safer security for yourself over the course of a long time, you're going to see those returns. Spencer, I got one last question for you before we wrap up here. It's my favorite question for all investors. If I were to turn over to you $10,000 right now, I'd love to know which individual stock you would throw that $10K into for the long term and just sit on it, hold it, and of course give us the rationale as to why.
Oh, man. See, I immediately jumped to like 5 different ones that I would split it up into. If I had to choose just one, this is a hard question. It really is. We've seen some insane returns. It really depends on what I would look for. If I'm looking for overall growth, well, you said that. Yeah, overall, just one. It's so funny, Ari, because I've shifted, like my whole mentality has shifted away from answering this type of question because I'm always like, diversify. Just one.
As you're spreading diversification, at least over on my channel, as a lot of my viewers know, I'm really spreading concentration. So it would be good to have you back and really talk about concentration versus diversification. And honestly, I see these two actually going hand in hand. To me, just while we're here and you're thinking about what stock to invest into, my mind just goes to what diversification really isn't necessarily building these, crazy portfolios of 100 plus holdings. It really comes down to spreading yourself across sectors to diversify and then finding the best opportunities within those sectors to really concentrate and focus on. So that's kind of how I've been spinning it over the years, because I too at one point had the 40 plus holding portfolio, and
Yep.
I've seen crazy amount of success after I changed and pivoted my strategy to more of a concentration Bill Ackman style, and hence why now I'm sitting at 2 ETFs and 6 holdings in the portfolio, and just a crazy return rate that I've been seeing over the last year or so since I've started doing that.
That's awesome. And
so
the ETFs.
I don't want to cue the Who Wants to Be the Millionaire, but I got to hear it. Where are you going with that 10K?
Okay, so it's tough because 10 years is a long time, right? Because I'm thinking like political time periods. Where are we going to be? Because if we were going to be in the same kind of climate, I would 100% do energy, like ET or ENB. But I can't dictate, I don't know who's going to win the next election. So I'm going to play it safe. And I would do Main Street Capital for the long run. It's BDC. The special dividends get you an insane boost on I think the dividend yield standing is like 6.5%. And with the special dividends over the last year, it's bumped it to like 9.5%. The year over year, it's growing at a rate of about 10% a year just in stock price. So I would probably have to do Main Street Capital. I talk about it all the time on the channel. It is definitely one of my favorites.
Investors, there you have it from Spencer. Spencer Invests is his channel. You have to go over to his channel and check it out. You're going to get all things like I share, not only investing, but really specific into the nitty gritty of investing into ETFs that are leveraged and income producing. So if you are looking for income, Spencer's your guy, and how to do that a little bit safer with some top-notch, I want to say, insights. Spencer, thank you so much for joining us on Masters of the Market. And investors, as always, until the next go-round of Masters, we will catch you all there.